You can divide investing styles into two effective categories. The first style is offensive or attacking style of investing. And this is where you go out and try to use your money to get more money. Sometimes this brings back a lot in return, but sometimes you end up losing what you set off with. The second style is the defensive style of investing. This is where you have a decent stash of money and you want to protect it. Yes, you want it to grow, of course, but not at the risk of losing it all. Dividend investing fits nicely into the second style, defensive investing. In this video, we'll discuss how to do it right. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. First up, what do I mean by defensive investing? Defensive investing is a strategy that aims to protect an investor's money from big losses during times when the stock market is unstable or the economy is doing poorly. Unlike aggressive growth strategies that focus on getting high returns, defensive investing focuses on keeping your money safe, preserving your capital, and earning a steady income. This approach is especially important when markets are unpredictable or when there's a higher risk of sharp drops in the value of investments. Defensive investors usually look for investments that are less affected by market ups and downs and can still provide reliable returns even when the economy is struggling. A key part of defensive investing is including dividend stocks in your portfolio. Dividend stocks are shares of companies that regularly pay out part of their profits to shareholders as dividends. These companies are often well established, financially strong, and operate in industries where demand doesn't change so much. Because of this, dividend stocks can offer a reliable income stream no matter how the market is doing, making them a valuable part of a defensive investment strategy. Now, as you know, dividend stocks are shares of companies that regularly pay a portion of their profits to shareholders. Dividend stocks are different from growth stocks, which are shares in companies that reinvest their profits back into the business to grow faster, instead of paying dividends out to shareholders. To make a defensive portfolio, we basically want to buy stocks that will help us to avoid wild swings from the market, pay a decent income on a regular basis, preserve the capital we started with, and allow us to compound over time. So let's see how we can construct a defensive dividend portfolio that does just that. And to start off with, we need somewhere to buy stocks. Right now, the best place to do this, in my opinion, and also the sponsor of this video, is Trading212. I asked Trading212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. If you've opened a new account recently or are planning to open an account, then here it is. DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support and thanks to Trading212 for sponsoring this video. So now you have the broker set up and maybe you have one already, but here's how dividend stocks suit a defensive portfolio. Lower volatility. Dividend paying stocks tend to be less volatile than non-dividend paying stocks, and volatility refers to how much the price of a stock fluctuates over time. Dividend stocks are usually issued by well-established companies with stable earnings, which means their stock prices don't swing as wildly as those of companies that reinvest all their profits into growth. Historical data shows that dividend stocks often perform better during bear markets, periods where the stock prices are generally falling. Because they provide regular income and belong to stable companies, dividend stocks can help reduce the overall risk in an investment portfolio, making them somewhat safer choice during uncertain times. Income generation. One of the most appealing features of dividend stocks is the reliable income they generate through regular dividend payments. Dividends are portions of a company's profits that are distributed to shareholders, typically on a quarterly or annual basis. This steady stream of income can be particularly attractive for investors who prefer a more stable return on their investments, as opposed to relying solely on the potential appreciation of stock prices. There is something more certain about getting income continuing to come in at a rate that you expect, rather than simply hoping that the price goes up and it's higher than when you bought it. Of course, no dividend is perfectly safe or guaranteed, but it's more guaranteed than stock price growth, so is appealing to those seeking a defensive investment. Regardless of how well the overall stock market is performing, many companies that pay dividends have a strong commitment to maintaining or even increasing their dividend payouts. These companies often have a stable, predictable cash flows and operate in industries that are less affected by economic downturns such as utilities. The types of sectors or industries that people will need or want, no matter what the economy does, are ideal here. This means that even when the stock prices are falling due to market volatility, these companies continue to generate enough profit to pay dividends. As a result, investors still receive regular income, which can be a financial lifeline during times when the market is performing poorly. This consistent income stream can serve as a cushion against market downturns, helping to soften the blow when the value of the stock itself declines. For instance, if the price of a dividend-paying stock drops, the income from dividends can offset some of the losses, providing a measure of stability in an otherwise uncertain market. This is especially important for investors who rely on their investment income to cover living expenses, such as retirees. On top of that, the regular income provided by dividends can also help investors avoid having to sell their stocks at a loss during a market downturn. Instead of selling off assets to generate cash, investors can use dividend payments to meet their financial needs. This allows them to hold on to their investments until the market recovers, preserving their capital and avoiding potential losses from selling in a depressed market. In summary, the income generation aspect of dividend stocks makes them a really valuable tool for defensive investors. The predictable, steady flow of dividends offers a level of financial security and can help protect against the negative impacts of a market downturn. For those seeking stability in their portfolios, the consistent income from dividend stocks can be a key reason to include them as part of a well-rounded investment strategy. Compounding effect. One of the most powerful benefits of dividend stocks is the potential for long-term wealth accumulation through the compounding effect. When you reinvest the dividends you receive back into more shares of the same stock, you increase your ownership in the company. Over time, this can lead to even more dividend payments, which can also be reinvested. This process of earning dividends on both your original shares and the new shares bought with reinvested dividends creates a kind of snowball effect, where your investment grows faster and faster over time. For investors focused on building wealth over the long term, the compounding effect of dividend reinvestment can be a significant advantage. Capital preservation. Capital preservation is a key objective for many investors, especially those with a defensive investment strategy. It involves safeguarding the original amount of money invested, ensuring that the value of the investment does not decline significantly over time. In the context of dividend stocks, capital preservation is particularly relevant because these stocks are typically issued by large, financially stable companies that have a proven track record of success. Dividend-paying companies are often industry leaders with well-established business models that generate consistent earnings. These companies operate in sectors that are less sensitive to economic cycles, as I mentioned earlier. For example, companies that provide essential services like electricity or food tend to have steady demand, regardless of economic conditions. These companies are also regulated and tend to be bigger. This stability in their operations translates to more reliable financial performance, which in turn supports their ability to pay regular dividends and maintain a stable stock price. Because of their strong financial foundations, dividend-paying companies are generally less susceptible to the dramatic fluctuations in stock price that can affect more speculative non-dividend-paying stocks. While all investments carry some level of risk, dividend stocks tend to exhibit lower volatility, meaning their prices don't swing as wildly in response to market conditions. This lower volatility helps protect the value of the initial investment, making it less likely for investors to experience significant losses. Another aspect of capital preservation in dividend stocks is the conservative nature of the companies that issue them. These companies often have prudent management teams that prioritize long-term stability over short-term gains. They typically maintain strong balance sheets with manageable debt levels, which reduces the risk of financial distress or bankruptcy. This conservative financial management further enhances the likelihood that the company will preserve its value over time, providing investors with the confidence that their capital is well protected. Now, no investment is entirely risk-free, but dividend stocks offer a relatively safer option for those focused on capital preservation. By investing in companies with solid financials, consistent earnings, and a commitment to returning value to shareholders through dividends, investors can reduce the likelihood of losing their initial investment. This makes dividend stocks a key component of defensive investment strategy, particularly for those who prioritize the security and longevity of their financial assets. And now you have a basis of a dividend portfolio that acts in a way to defend your wealth. However, not all dividend stocks are the same, and there are risks that you need to watch out for. Dividend cuts. One of the primary risks of investing in dividend stocks is the potential for dividend cuts. Companies that pay dividends do so from their profits, but if a company's financial situation worsens, especially during economic downturns, it might reduce or even eliminate its dividend payments to conserve cash. This can happen for various reasons such as declining revenue, increased debt, or unexpected expenses. When a company cuts its dividend, not only does the income stream for investors shrink, but the stock price often drops as well, as investors react to the news. It's a double whammy of pain for investors. This can result in both a loss of income and a decrease in the value of your investment. Therefore, it's important to assess a company's financial health and its ability to maintain dividend payments over time before investing. Interest rate sensitivity. Dividend stocks, especially those with high yields, are sensitive to changes in interest rates, as when interest rates rise, newly issued bonds and savings accounts can offer higher returns, making them more attractive to income-seeking investors compared to dividend stocks. And as a result, the demand for dividend stocks might decrease, leading to a decline in their prices. Additionally, companies that pay high dividends often have higher levels of debt. Rising interest rates can increase borrowing costs for these companies, potentially squeezing their profits and making it harder for them to maintain their dividend payouts. Investors should be aware of the interest rate environment and how it might impact the attractiveness and performance of dividend stocks. Sector concentration. Another risk in dividend investing is sector concentration. Many dividend-paying companies are concentrated in certain sectors like utilities, consumer staples, and real estate. And while these sectors are known for their stability and consistent demand, over-concentrating your portfolio in these areas can expose you to sector-specific risks. For example, if there's a regulatory change that negatively impacts the utility sector, or if consumer habits shift away from the products offered by your consumer staples companies, the value of those stocks could decline, affecting your overall portfolio. To mitigate this risk, it's important to diversify your investments across different sectors and industries, ensuring that your portfolio isn't overly reliant on the performance of just one area of the market. In conclusion, dividend stocks offer a compelling strategy for defensive investing, providing a balance of income generation, capital preservation, and lower volatility. By investing in stable, well-established companies that consistently pay dividends, investors can create a portfolio that not only generates regular income, but also helps protect their initial capital against market downturns. However, it's crucial to be mindful of the risks involved, such as potential dividend cuts, sensitivity to interest rate changes, and the dangers of over-concentration in specific sectors. By understanding and managing these risks, investors can effectively leverage dividend stocks to build a resilient and reliable investment strategy that aligns with their financial goals. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!